Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Welcome to another episode of Supernatural Stocks. It's great to be back, and in this podcast, I will be explaining the latest investment that I've made in my tax-free savings account. It's a risky one, so take that into consideration as I walk you through it. Before we get to that, I do want to just highlight last week's show about why I love my tax-free savings account, or TFSA, so much, and the rotation I made from US big tech into local property and bond ETFs. The price action in the past week around the Nasdaq suggests that there is weakness in the big tech share prices, so it may have been a well-timed move. We will have to wait and see. Either way, go check that podcast out if you haven't done so already, because it does set the scene for why ETFs within a tax-free savings structure are just so powerful. Themes are good for birthday parties and portfolios, and before I get into the investment that I've made here, we need to talk about why investing in a theme is a different ballgame to choosing a specific company. For example, saying I love software as a service as a business model is completely different to investing a meaty percentage of your portfolio in Adobe, Salesforce, or Intuit for that matter. A thematic investment should spread the risk across the theme by owning a number of companies, thereby reducing the risk inherent in a concentrated portfolio. Taking the route of holding only a handful of stocks, yes, that might talk to the broader theme, but what you're actually doing there is your stock picking, and that requires deep research into those stocks, not just the theme. It's tempting to think that buying an ETF immediately achieves the diversification across a theme, but that's also not always the case. For example, your theme might be to invest in cutting-edge technology across a number of verticals. To try and achieve this, you go and buy a NASDAQ 100 ETF, because you read somewhere that this is a more tech-heavy play than the S&P 500. An example could be the Satrix NASDAQ 100 ETF, which trades on the JSE under the stock code STXNDQ. Now, whilst it is true that the Nasdaq is more of a tech slant than the S&P 500, you absolutely need to dig deeper than that into the index to understand what you are actually buying. A NASDAQ 100 ETF will give you a portfolio in which Microsoft, Apple, and Nvidia together contribute nearly a quarter of the exposure. There is a heavy skew not just towards technology, but towards the classic big tech concept. And once you reach the bottom of the list of the 10 largest holdings in that ETF, you've accounted for roughly half of the portfolio, so it is quite concentrated. Now, Nvidia is certainly cutting-edge technology, but can the same really be said for Apple? Also, what on earth is retailer Costco doing in there as the 9th largest exposure? I mean, that's not technology at all. The broader the market index, the less likely it is that you are getting close to a theme. This is no fault whatsoever of the ETF or the index or the way it's been built, because broad market exposure is the right reason to buy this specific ETF. It's just a mismatched objective, assuming you are looking for a more specific theme than the NASDAQ 100 can give you. Now, US-based ETF providers understand this concept, and on top of that, they have a market that has deep liquidity to support the introduction of niche ETFs. So you'll find all kinds of interesting ways to play themes in that market. For example, if you search for a cloud computing ETF, you will find examples like the First Trust Cloud Computing ETF, which trades under the ticker SKYY. It has Oracle as its largest holding at 4.5%. Other major holdings include Arista Networks, IBM, Pure Storage, and Cloudflare, among the usual suspects like Microsoft and Amazon. In the Wisdom Tree Cloud Computing Fund, which trades under WCLD, the top 5 holdings are companies that are way less impressive than those, bluntly. Q2 Holdings, Squarespace, AvePoint, Wix, and Toast. For the sake of finishing this point, the top holdings in the Global X Cloud Computing ETF, which trades under CLOU, C-L-O-U, are Wix, Digital Realty Trust, Zscaler, SPS Commerce, and C3.ai, not exactly household names. Now, these ETFs theoretically have the same underlying theme, yet there is minimal overlap in the underlying holdings. And what's more, the percentage exposure to each company varies across the ETFs. Thinking of these ETFs as a passive investment would be a major mistake, because there is arguably even more research that needs to go into buying these ETFs versus an index tracker that is much easier to understand. Coming closer to home, South Africans tend to think of ETFs as passive investment instruments, perhaps because we've grown up on this diet of index trackers. Active ETFs are now available on the JSE, and the jury is still out on how popular they will be as providers look to bring alternative products to the market. Personally, I wish someone would list an ETF that just tracks a basket of local retail stocks. It is beyond me how such a large sector in our market has neither an index nor an ETF. I wish something would change about that. Nonetheless, although the ETF market in South Africa is in its infancy relative to the US, there is still quite a lot available locally for you to sink your teeth into. Like in the US market, once you step beyond the obvious and commoditized choices like a top 40 index ETF, you do have to look at the constituents and figure out whether the ETF you're looking at could achieve your desired portfolio objectives. Now, this brings me very neatly to what I'm hoping could work out well over the next 6 months to 12 months. The Signia iTrix 4th Industrial Revolution Global Equity Fund, which trades under the ticker SIG4IR, that is SYG4IR. And although this has been around for a while, this is not one of the new active ETFs. It is very, very interesting. Now, SIG4IR and I have had a romance before. I held it previously when frothy tech was all the rage. This ETF had a terrific time of things in 2020, rallying like mad into the end of the year, before having a choppy time in 2021 that eventually led to a precipitous drop in January 2022, followed by a steady decline into mid-2022. And since then, it's been a difficult journey of false starts and frustrating lack of momentum, driven by considerable troubles in the world of, wait for it, cutting-edge technology, like we referenced earlier. Today, this ETF is 86% higher than it was 5 years ago, so returns have been decent, but not extraordinary. Over the past year, the price is not even 4% higher. Perhaps most importantly, it is still more than 20% off the peaks in 2021, so those who bought right at the top have taken quite the bath. As a final data point to set the context around the price, the 52-week low is almost 23% lower than the current price, and the 52-week high is barely 4% higher. So you have to be careful here. On these metrics, there needs to be decent reason to believe that the price can break meaningfully higher. And this leads me to the investment thesis, from big tech to small tech. The largest holding in the SIG4IR ETF is Teledyne Technologies with only a 1.1% allocation. Don't worry, I had never heard of it either. For what it's worth, the company is an industrial conglomerate that operates in areas like digital imaging, instrumentation, engineered systems, aerospace, and defense electronics. That does sound cutting edge to me. Do I need to dig much deeper than that? Well, not actually for this trade, no. Because if the biggest holding in an ETF is 1.1%, we are talking about a well-diversified portfolio that takes out the single stock risk. Even if Teledyne, as the biggest holding, went bankrupt tomorrow, it is only 1.1% of my money in this fund. And this fund is only a small percentage of my total portfolio. So the time benefit of doing deep research in that company is non-existent for me. Unlike in a market cap weighted index ETF, I don't need to worry that much about individual holdings. Instead, I just need to ask myself what theme it is that I'm trying to get my hands on. Firstly, I like technology and I want exposure to it. Secondly, I want offshore exposure, especially with the Rand having been given a boost by the GNU euphoria. That is not a bad time to get into a global feeder ETF, as the stronger Rand makes it cheaper to buy. Thirdly, having just rotated out of much of my big tech exposure, but not all of it, I'm looking for technology companies that haven't run as hard as big tech. And finally, I'm taking a view on technology companies that on average have longer dated cash flows than the big tech players that have dominated the market for the first 6 months of the year. In other words, there is an expectation that they make a lot of money in the future rather than a lot of money today. In an environment where interest rates should come down in the next year, this is supportive of the valuations of these smaller tech assets. And here's a really interesting final piece of analysis, that this is not just an interest rate trade. I'm comparing the fund now to Cathie Wood's ARK Innovation ETF, which trades under the ticker ARKK. Now, we have to be super careful with currencies here because you can't plot a Rand return against a dollar return and directly compare them. You can't take the Signia 4IR fund and plot it on the same chart as ARK and make a conclusion. Instead, you can go to the source of this index tracked by Signia, and I've included the link in the associated article with this podcast, and look for a way to get the dollar pricing on the index. Now we can compare it with Cathie Wood's ETF. And there is a US-based ETF tracking the same index, trading under the ticker COMP, K-O-M-P. So if we chart COMP against ARK, we can see that although they are closely correlated, the level of volatility is very different. ARK experiences much wilder swings because the companies in that fund are way riskier than they are in Signia 4IR, which includes a number of profitable industrial groups, not just wild, swing for the fences type business models that you'll find in ARK. Over 5 years, the index tracked by Sig 4IR returned 43% in dollars. The ARK Innovation ETF, that's down 3% over 5 years. Now, if you listened carefully earlier, you would remember that the Signia fund has returned 86% over 5 years, and yet the overseas index has only done 43%. Literally half the return is Rand weakness. Another good reason to think about offshore, but also to be careful about running offshore when the Rand is very weak, because the Rand moves can hurt you. For me, Sig 4IR is a happy medium between the NASDAQ 100 and the really frothy stuff you'll find in ARK. It achieves my objectives, and I hope that it works out as part of my portfolio. And best of all, it is listed right here on the JSE, so the point is I can buy it in my tax-free savings account. I'm not expecting to make any other changes to my TFSA portfolio at the moment, by the way. Roughly 60% of the portfolio sits in property and bond ETFs locally, and the rest sits in offshore equities, with much less exposure to big tech than I had a few weeks ago. I'll now let it run and hope that this works out the way I planned. Nothing, as ever, is certain. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.